Chapter 25. Score cost, it's a late day. Standard cost and balanced scorecard. Mainly standard cost, okay? They talk a little bit about the difference between budgeting and standards over on page 1160. The bottom line is this, or actually 1161, the bottom line is this. When we were doing the budgets, we were talking about the total amount of cost we were spending for materials or for labor. Well, we didn't know it at that time, but we actually had to have the standards to do the budgets, because the standards are what you're going to spend per unit. It's a planned amount per unit. So you actually have to develop your standard costs before you ever even get ready to do your master budget. So a standard cost, for example, would be for materials, how many materials, pounds, ounces are you going to use per product you make, and then what would the price be. A labor budget would be how many hours is it going to take to make a product, and then what's the price per labor hour that you're going to pay. So in the example we're going to talk about in standards here, we're going to go back to our factory a little bit where we talk about the direct materials, the direct labor, and the manufacturing overhead. We're going to try to find the standard cost of making one product. But this would apply to a service business as well. The only difference is you just wouldn't have inventory if you were doing, you wouldn't have direct materials if you were doing a service business. But you could still have labor standards and overhead standards. Okay. So over on, they just also mentioned on the bottom of 1161, this might pop up somewhere, the difference between ideal standards and normal standards. Ideal standards are everything is perfect, and normal standards are they're operating at an efficient level and they're attainable. You want to make sure when you're setting standards, you don't set standards too high. Because if they are ideal and perfect, you have to be perfect to do them, people are going to not try to do that. So I like to use the example, in this accounting class, it's possible that under ideal conditions you could get every single point on every single assignment. But if I made the A require that you got 100%, that'd be not very motivational, would it? You guys all be you'd all be mad because it wouldn't be attainable. It'd be very hard to do that. So what we do is we set the A at what we consider a normal standard, which is 90%. The idea is if you get 9 out of 10 points on all the assignments, you're demonstrating an understanding, a high understanding of the material. So think of that. Ideal would be the 100%. Nobody wants that. It's not attainable. It's not realistic. The 90% still stretches people, makes them work, but it gives them something that's attainable. So that's a difference between ideal and normal standards. Over on page 1162, they start going through this case study of an example of standard cost. Now they go through and they talk, and this is important to keep in mind on page 1162, they go through and they say when we're talking about our standard cost for our materials, it's not just what we pay for the materials, it also includes things like freight and the cost of handling and shipping and all of that. So that's part of our total cost per pound or ounce or whatever our direct material unit is. Same way up above on the 1163, they talk about, well, how about the quantity that we use? Our production people say, how much material, direct material should we use to make a product? Well, it's not just what actually goes into it, it's also if we have any waste or spoilage, we have to add that into. And the same thing when we talk about labor, it's not just what we pay people for their hourly rate, it's their fringe benefits, it's their payroll taxes we have to pay on them, all that gets added in. Any cost of living adjustments or inflation gets added in. And then right below that on page 1163, they talk about the direct labor quantity standard. Maybe somebody says, it takes 1.5 hours of our assembly line people making this product, but we have time where we have to stop for breaks for lunch and safety breaks and that sort of thing, so that takes a little bit of time. And also we have time where we have to stop a production run at the end of the day and shut things down, so we're not making things, but those people are still there, they're getting paid. All that has to be factored into that labor standard per hour. So it's not just the actual expense, there's anything else that goes into making sure that that cost is there. Now when we do that, we end up coming up with what our actual costs are, and they show that on the bottom of page 1164. Our actual costs become, our standard costs I should say, become the standard quantity times the standard price. So in this particular case, we go through, and again we're doing it for direct materials. We have direct materials. We have direct labor. And we have manufacturing overhead. So what we want to do is we want to come up with a cost of what it should cost us to make this product. So we're going to take our standard quantity, standard quantity, which is how much we think we should use, times our standard rate, and that's going to give us our standard cost. Okay. So in this case, we go through and we say every time, the production people say every time we make a product, you should take 4 pounds, including all the waste and everything else. And the purchasing department says, well, it should cost us $3. That's what we think the cost is going to be next year, including things like delivery cost and everything. So therefore we say, well, it should cost us $12 per unit for materials. Do the same thing with our labor. The production people says, well, it should take about 2 hours of labor for every product that we do. And Human Resources says, well, we look at paying about $15, including all the fringe benefits and everything. So that works out to be about $30. And then our manufacturing overhead, we use an overhead allocation rate, predetermined overhead rate based on direct labor hours. So we say, well, we're going to work 2 hours in every product, and the rate we're going to use, it looks like that overhead rate was $5. So every product we should add $10 in for the overhead. So when we're done, we end up with a standard cost of $52. So that's what we think it should cost us every time we make a product. Now we set this standard back in the budgeting because, of course, these pieces of information up here need to be used in our direct materials budget and in our direct labor budget. But this is what our cost becomes, and so now the people that are running the factory use this to measure their actual production to see how well they're doing, see if they're on track. So let's go through an example here. So this is over on page 1165. And so what happens here is they go through, we have a situation where we have an actual job we worked on, okay? So this was our actual job. So our actual cost that we spent on this job, we spent for direct materials $13,020. We spent for direct labor $31,080. We spent on variable overhead, they split our overhead out, $6,500. And then we spent on the fixed overhead $4,400. If you add that all up, that became $55,000. That's what we really spent. How do we know what that was? Well, because that's what we had on the job cost card. Remember the job cost sheets we talked about back in cost accounting? Yeah, that section, so long ago. Well, that's how we kept track of that. Now, why do you care? Well, because you're the production person. No, you're not the production. You're the salesperson. And you have just got the results of what this was, and you're trying to see how much profit you made on this. And you're a little upset because this is higher than you expected. As a matter of fact, they had a standard cost over here that they estimated. The standard cost is the actual units, which in this case was 1,000 units. That's what you had agreed to sell, 1,000 units, times the standard price, right? Standard price. And what's the standard price or standard cost?
52.
It was 52. That's what you just came up with up here. So when you went through and you did your bid, you used a cost of $52,000. Because that's what they told you. It should cost $52 for everyone. And then you set your profit on top of that and everything. But now they're telling you, no, it costs $55,000. And you're saying, wait a minute, that just took $3,000 of my profit away. I'm not making as much profit as I did. Okay? This is what we call our total variance. And in this case, it's a $3,000 unfavorable. U means unfavorable. F means favorable. Because the actual costs are higher than the standard cost. And you want to know why. What happened? There goes my bonus. Okay? So that's how we set the standards. Come up with the standards, this is how we use them. Now, the problem with that is that doesn't really tell you what's going on. It doesn't tell you who to go talk to. It doesn't give you a lot of information. So how do we further break that down? Well, that's where we go into looking at the breakdown between the variances for each of these items. Because we have direct materials, direct labor, and manufacturing overhead. And so what we want to do is we want to be able to find out what the variances were for each one of those items. Okay? So they're going to walk you through some formulas on page 1167. I'm going to use the diagram they have over on page 1168 because I'm a kinesthetic learner, so I'd rather see pictures and formulas, okay? but I'm going to show both of them to you. And the good thing is, once we go through this, we're going to use this same approach to find the variance for both materials and the labor. So let's go through and talk about how this would work, okay? So the first thing we want to do is we want to find out how much of this variance was caused by direct materials, how much was caused by direct labor, and how much was caused by manufacturing overhead, okay? So the first thing we're going to do is we're going to go over here and we're going to do our direct materials, okay? So we're going to start with the information that they give us on the bottom of page, where is it here? Because all this has to be given to us, on the bottom of page 1166. They're going to go through and start telling us how much we used, because we have to know how much we really used versus what our standards were, okay? So I'm going to set the formula up this way. I'm going to take over here, these are going to be my actuals, okay? So I'm going to draw a line here to make this nice and neat. So I'm going to have my actual quantity times my actual price. Okay, everybody with me? Okay. And so it gives me, it tells me in there, I went through and I used 4,200 pounds of direct materials. So my actual quantity was 4,200 pounds. And my actual price that I paid was $3.10. And so if I multiply that out, that gives me $13,020, which coincidentally, well maybe not, should be, is exactly what we have over here for our actual cost. Because that's what I actually spent. That information came off the job cost sheet. Alright, so that's how much I spent. I know that. I had that over here. How much should I have spent? Well, that's where we go over here and we look at the standards and say, okay, let's take the standard quantity times the standard price. Okay. Now in this case, we're doing materials, right? So let's just do this. This is materials, direct materials. We're going to change this in a little bit, but we'll do direct materials. So our materials, our standard, how much should we use for materials? We should have used 4 pounds per unit, right? Well, how many units did we make?
1,000.
We made 1,000 units. So I need to go over here and I need to find my standard quantity. My standard quantity is going to be my actual units times my standard unit price. So I take 1,000 units times $4, not price, unit quantity. Sorry, it's getting late. So that's 4 pounds. So that's going to give me $4,000, or 4,000 pounds. I keep wanting dollars here. And then my standard price, what was my price? It should be $3, right? So that should be $3. So that's going to be $12,000. So my actuals were $13,212 and my standard was $12,000. So I'm going to go up here, I'm going to draw my arrow this way. Because this is going to give me my total direct material variance, which is $1,020. Now, students always get this wrong. Is it favorable or unfavorable? Well, ask yourself, are the actuals higher or lower?
Higher.
Higher. And is it good to have your costs higher?
No.
No, that's not good. So not good is unfavorable. So that's going to be unfavorable. All right. So we've just answered part of this question. Our direct materials in total are $1,020 unfavorable. So of that $3,000, part of it's materials. But now I'm going, okay, well, whose fault is this? Is it because we used too much or we paid too much? So now what I want to do is I want to break this into 2 different pieces. I want to break it into my price variance and into my quantity variance. Now there's 2 ways you can do this, okay? There's a shortcut. If you use the diagram, you've got these 2 numbers already. You can actually do this. You can do a number in the middle. You don't, it's not, this is actuals, this is standard, this is kind of a blend. It doesn't really have a name, but what it is you're going to bring over the actual quantity and you're going to bring over the standard price. And if you do that, you have 4,200 units, or 4,200 pounds, times $3. That works out to be $12,600. Okay? If you do that, you can already find your variances, because the difference between these two is going to be your price variance, And the difference between these two is going to be your quantity variance. But just because I want people to understand how the formulas work as well, let's do it with the formula. So we're going to go through and we're going to try to find the difference between these two, okay? And this is going to be my direct material price variance. Okay? Well, what do I do? What's the formula for that? Well, the formula for that is my actual quantity times my actual price, which is this formula right here, so it's the 13,020, minus this formula, my actual quantity times my standard price, which, if I multiplied that out like I did up here, is 12,600. And if I look at the difference between those, it's $420 is my difference. And because my actuals, because these are actuals, in other words, I know my price was higher because I paid $3.10 and I only should have paid $3, so I know I paid more, so I have an unfavorable variance. This is going to be unfavorable. Okay. I do the same thing over here. I can do the formulas for doing my direct material quantity variance. Okay. Well, my formula for that is going to be my actual quantity times my standard price minus my standard quantity times my standard price. So again, if I just carry this formula over here, it gives me 12,600. If I carry this formula down here, it gives me the 12,000. And I have $600 difference. Is it favorable or unfavorable? Well, again, I look at this and I say, well, I used 4,200 pounds. I should have used 4,000 pounds. I used 200 pounds more than I should have, so since I used more than I should have, that's probably too high a cost, so it's unfavorable. So it's unfavorable. And then just to be checking it out, I go through and I say, okay, what do those two add up? 4,200, $4,420 unfavorable. Since they're both unfavorable, I add them together. That's 1,020. Oh, guess what? That's my number up here. This is my way of checking. So I said my total direct materials variance was 1,020. That's because my price was unfavorable by 420 and my quantity was off by 600. So now I can go, oh, okay. So now I'm going to go down to the purchase department and say, hey, what's going on? You guys ended up paying 10 cents more than you should have. That cost me $420. What happened? And maybe they say, well, you had a rush order and we had to pay premium shipping, so we had to add shipping cost in. Okay. You go down to the production department, to whoever's in charge, the foreman, you say, hey, what's going on? You were only supposed to use 4,000 pounds and you ended up using 4,200 pounds. And you find out why they used 200 pounds more, because that cost you $600. So this is giving you the idea of how much of this variance over here is happening where and who to go talk to. It doesn't tell you why it occurred, it just tells you who to go talk to find out what happened. Okay? So that's the variance for the direct materials. Any questions on that? Now, you can do it, I prefer to do it this way, because basically, if I do this, and I remember my left and right and bring them over, I can answer all the questions. Some people prefer the formulas. If you do, then just remember, direct materials price variance is this formula, direct materials quantity variance is this formula. You'll get the same answers. Okay? On the test, these will be multiple choice questions. So I'm not going to care how you calculate them. You just have to be able to find them. Okay? They'll probably be like multi-part questions where I'll give you a scenario and I'll say, okay, find the total direct material variance, and then find another multiple choice question, find the price variance, another multiple choice question, find the quantity variance. So it could be like 3 parts.
So you still do the formula?
You can do the formulas. No, if I was doing this and just drawing it out and I did this, I could stop here. I could just take the difference between these is 420. The difference between these is 600, and I'd be done.
Oh, I see.
I wouldn't have to do this. I only do this because there are people who like the formulas. I ask for the daytime classes, show of hands. More people like the formulas than like the graph. So I don't care. Either way works. The book shows this on page 1168. They show you both ways. So, but it doesn't really tell you why they're showing it to you that way. So that's what I'm trying to explain. The other thing is people get this wrong. On the multiple choice questions, do you think I'll go through and give you 2 answers, and one is 1,020 unfavorable and one is 1,020 favorable? Oh yeah. And about 20% of the students miss it. they get the right number, and then I don't know, 50% favorable. You do that? How do I know if it's favorable or unfavorable? Just go back and look and say, okay, I'm trying to find the price. Was the actual price higher or lower? If the actual price is higher, unfavorable. If the standard price is higher, favorable. Go over here in the quantity. How much did I use? Did I use more actual usage, higher than standard usage, unfavorable? So just go back to whatever the item is the variance is about and see, was the actual higher or lower? And that's going to tell you if it's favorable or unfavorable. That's all you need to know. Don't get hung up on the math part. The math is where they get stuck. Okay? So that's the direct material variance. Now what's nice to know is that the direct labor variance uses exactly the same format. They go through and they actually change the wording a little bit. You don't have to. I will just to make it clear, but it's basically the same setup and the same formulas, okay? So let's go through here. I'm going to erase the numbers that we have because we're going to redo the numbers. And then I'm going to change the terms. But if you didn't change some of the terms, it really wouldn't matter because you get into the same calculation, right? So instead of direct materials, now we're doing direct labor. And instead of actual quantity, it's actual hours. Instead of actual price, it's actual rate. And so this is going to be direct labor, DL. This is going to be actual hours. This is going to be actual rate. So again, doesn't matter if you make these changes or not, you should get the same answer, but I just want to be consistent. Standard hours and standard rate. Okay? And this is going to be now actual hours. And then down here, again we change it. That stays quantity, but now it becomes direct labor quantity. And this becomes direct labor rate variance instead of price variance. And AQ becomes AH. And AP becomes AR for actual rate. Actual hours, standard rate. Actual hours, standard rate. Standard hours, standard rate. And now boom, we're done. Magically, we turned it into a labor calculation. Right? So then they just go through and they give us some more details. And again, this has to be given to you. They go through on the bottom of page 1169. They say, okay, to make this zonic tonic, whatever that is, we had people working 2,100 labor hours at an average hourly rate of $14.80. So our actual hours were 2,100 hours. And we really paid them, do I have the right one here?
$14.80.
We really paid them $14.80. So that worked out to be, we spent $31,080 in labor, which, hey, guess what? That's pretty much what we spent, because that's what's over here on the direct labor, on the job cost card. So that's our actuals. Our standards worked out to be 2 hours, should be 2 hours per unit, and we made 1,000 units, right? So it should be 2,000 hours, and we should have paid $15 an hour. So this should be $30,000. So our actual should be 30. We paid $31.80. Are we favorable or unfavorable? We're unfavorable. Our total labor variance is $1,080 unfavorable. So now we know over here, this $3,000 variance, 1,080 of it is unfavorable because of labor. Now the question is why? Were people inefficient, or did we pay the inefficient people too much? So let's look at that. So let's look at the rate variance, okay? Now again, if you want to take the shortcut, just remember, actual hours, 2,100 hours, times the standard rate, $15, gives me this kind of middle calculation, which is 31,500. And now I'm done. I take the difference between these. These are my rate variance. I take the difference between these, That's my quantity variance. So I wouldn't have to do any more calculation. I could answer my question, go on to the next problem. But if I wanted to do the formulas, let's just do the formulas. So my actual hours of 2,100 hours times my actual rate of $14.80 gives me a cost of $31,080. My actual hours of 21 times my standard rate of 15, which is this formula, gives me 31,500. So I look at that and I'm going, oh, is that favorable or unfavorable? The difference is 420. How do I know if that's favorable or unfavorable? Well, look at my rate. I paid $14.80 per hour, and my standard was 15. Was I favorable or unfavorable? Yeah, my actual was under. That's favorable, so that's going to be a favorable variance. Okay. I saved money. I saved 20 cents an hour by paying them less than the standard. Go over here, the same thing. My actual hours times my standard rate, this number here. I carry over 31,500. My standard amount of 2,000 hours times $15 is 30,000. My difference is $1,500. And in this case, I used 100 hours more than I should have. Is that good or bad?
Right.
That's bad, so that's going to be unfavorable. So in this case, I have an unfavorable variance and a favorable, so they're going to net out. So, but they net out and leave more unfavorable. So I end up with 1,080, and guess what? That's what I had up here. So this tells me I must have done the right calculation when I was up there. So now I can go back to the production people and say, hey, how come you guys look it through and you had people working so many more hours? Why did they work another 100 hours, okay? And I go back to the payroll department and say, good job, you got people in here, but the people you paid less money for aren't very efficient. So give me different people next time. Okay? But at least you know who to go talk to and how much the amount is. Okay. So that's how you'd find the variances for both direct materials and direct labor. They're basically the same format, the same calculations. Now the last number they have here, I'm not going to get hung up on the overhead. Basically what happens is you can see the overhead over on page 1172. They take the actual overhead, which was given to us of 10,900, and then they apply the overhead. They say it's the number of standard hours, which was 2,000 because we apply overhead on labor hours, times the standard rate of $5, so that's 10,000. Now if you really want to know, when you get into your upper division cost accounting, we split the overhead variances into fixed overhead variance and variable overhead variance, and it gets kind of confusing. It's actually in, I think, Learning Objective 5 in this book. We're not going to do that. But if you want to read about it, that's something we would talk about in the upper division cost class. But here we're just going to say, don't worry about the overhead. It's just the difference between what we applied and then what the actual was, and that worked out to be a $900 unfavorable variance. And so now you can see when we add up these three unfavorable variances, that gives us our 3,000. So now we're able to say, okay, we now know why we had $3,000 more costs. We may not be happy about it, but at least we know where it was. It wasn't in one place, it was scattered out. So the whole factory's screwed up. It's not just one part of it. Okay. But this lets us know. So if we were a manager or somebody, we would know who to go talk to and see what needed to be fixed. That's why we do this. Not because it's fun. Not because it's hard, but because it's necessary. So that's pretty much all you need to know. Like I said, these will be variable. These will be multiple choice type questions, and you can probably see something for direct materials, something for direct labor. So you could see several, 3, 4, 5, 6 multiple choice questions coming out on this. So expect that. The last section they talk about is more theory. It's the Balanced Scorecard over at 1175. All you really need to know about the Balanced Scorecard is managers don't just care about the bottom line financial numbers. I know it seems like it's always just profit, but it's not. They care about other qualitative things. Employee morale, customer satisfaction, quality control, customer or company reputation. And so the Balanced Scorecard says we're going to create standards in each of those areas. And they actually show some of those on page 1176 and 77. One standard might be financial standards, another area might be customer standards, another might be their internal processes, think quality control and efficiency. Another one might be learning and growth, employees and training them, keeping your workforce trained and motivated and high morale. And so what happens is by going through and balancing the scorecard out and listing different major areas that the company wants to focus on, then it can say what kind of numbers can we use to evaluate this. And so maybe under customer satisfaction, you might look at the number of complaints. You might track the number of customer returns. You might do satisfaction surveys. Under internal processes, quality control, you might do an ISO 9000 audit to see how you're doing. The point is, there are measurements you can use that aren't necessarily just dollars and cents. Management accounting can help gather those numbers. It's not just about the financial numbers that we look at. We also care about things like quality control and customer satisfaction and things like that. And we want to measure those and create standards for those. So the balanced scorecard is a way that big companies say, let's make sure we're looking at all the pieces, not getting target fixated just on profit or on cost control. So that's what you need to understand from a management standpoint, how it's used and how management accounting fits into it. And that's pretty much all that you need to know on Chapter 25, Standard Cost and the Balanced Scorecard. If you haven't been watching those little videos that they have, you've been watching those?
Mm-hmm.
They're actually very good.
Yeah.
And the ones on these are very good because they kind of explain these concepts that are kind of fuzzy theory things and show how companies actually use them to improve their operations. So they're worth the 6 or 7 minutes it takes to watch them. So.
Yeah, we actually, working in retail, we use the scorecards.
You use the Balanced Scorecard? Good.
And we have to keep track and, sit down and talk to employees.
Every so often you sit down and you have to measure it because you look at your standards and see how you're doing. That's good. It's good that you do that.